Welcome to America's Commercial Real Estate Show, your source for market intel, forecast, and strategies. Hello, I'm Michael Bull. I appreciate you being with us. Our show today is brought to you by commercialagentsuccess.com. If you are a commercial agent and you want to perform better for your clients, you owe it to yourself to check this out. There's 21 videos, and they're in the cloud. You can access them instantly. In fact, if you want to order one because you don't think it's great, I know there's a lot of terrible commercial agent training out there, believe me. And this is different. You can try one, and if you let me know within 3 days, if you don't like it, we'll give you a full refund. Learn more at commercialagentsuccess.com. Well, today we're going to talk about a sector that is on everyone's mind these days, and that's the office sector. Obviously, it's been most in question with what happened with COVID. And of course, like all the other sectors, the rapid increase in interest rates has caused some distress. And the office market has had some pretty high vacancy, right? And it had transaction volume kind of stalling, lenders not wanting to do loans in some cases, which hurts any sector. And then you have some lenders kind of kicking the can down the road on the distressed stuff. But we are seeing activity pick up on both the leasing side and performance. We are seeing transaction starting to pick up, and I'm saying that as a participant in the industry because I sell office buildings and own a commercial real estate firm, Bull Realty, here in the Southeast, and we've certainly seen activity. But what's really happening? Let's invite our guest in. You know him, it's Phil Mobley. He's National Director of Office Analytics with the CoStar Group. Phil, good to see you, sir.
Hi, Michael. Pleasure to be back on the show.
Yeah, thank you. And to start us out, I think the world wants to know, when you look at the U.S. And you look where we are in a year to date, what's happening out there? Because in some cases people see a lot of vacancy, but we're hearing that there's more demand, and tenants seem to be, in some cases, not being able to find what they want. What's really going on?
Well, I think all of the above, Michael, which makes it such a fascinating sector to be involved in. I would say that we might be near an inflection point. So here we are, it's early October as we record. So Q3 data is fresh. We're still finalizing it here at CoStar. But the early indications are that we may have seen something shift in the national office market. Our early estimates suggest something like 10 million square feet of positive net absorption nationally. Now, we haven't seen anything like that since early 2019. So one quarter's data does not a trend make. However, there are some signs underneath that there is some strength, some robustness to that positive 10 million. One of those signs is that we began to see the backfilling of our 3 and 4 star product, which you can think of as your Class A and B product, below the trophy level and above the sort of non-institutional grade. So that's the type of space that had in many cases become commoditized. It was expensive on the one hand, but not necessarily differentiated enough to be competitive with trophy space on the other. And so it had been really struggling to maintain and certainly to backfill occupancy. But that seems to have started to change nationally here in the third quarter. And as a result, our national vacancy rate has plateaued. It's at about 14% as of the end of the third quarter, which is an all-time high by our reckoning. As a comparison, it peaked about 12.6% during the Great Recession. So still elevated, still high vacancy, as you alluded to, Michael, but we may be near that vacancy peak at last.
Interesting. Now, this 10 million positive absorption, does that include buildings that were removed from the market, helping that number?
So the supply side of the market is a really fascinating one right now. The absorption would just be the demand side, but of course, the supply is also impacting that vacancy rate. So we've had a diminishing amount of net new deliveries, which is helping to keep vacancy, or has been helping to keep vacancy from rising even further. As we look ahead, we've had for the last year and a half essentially record low construction starts. We had until the third quarter, if you look back the previous 12 months, we had something like 20 million square feet of new office buildings start. That would have been a good quarter in, say, 2018. So way low in terms of the historical level of new construction. Looks like that ticked up again in Q3. But the implication of that is that for the coming months and really years, we're going to have a lot less new supply coming on than we have, and we've already had a little less in the last couple years than we were used to before 2020.
Interesting. What about demand? So that's great news, the positive absorption overall. Where do you see this demand come from?
Well, it's one of the really fascinating things about what's been going on in the last few months is we've had this really wide divergence in performance across geographies. So, at the major metro area, if you take, say, the top five office markets in the country by square footage, New York is obviously the biggest one. New York had the lion's share of that positive absorption that I mentioned a few minutes ago in the last quarter. Dallas is also in that top five list, positive absorption there as well. It's nothing new for Dallas. And in fact, New York has been positive for, I think, 6 quarters in a row now. On the other hand, you've got a couple of the largest markets that are still struggling to maintain occupancy. So, Los Angeles, Chicago, Washington, D.C., all very large office markets, all still experiencing negative absorption. So, if you zoom out to kind of macro level factors there, um, Washington, D.C., certainly in the news with everything from the Doge cuts to the government shutdown that's still currently underway as we're recording. I think the near term and medium term view is for the impact of the federal government to really affect GDP and economic growth and hiring in that market for a while. It already seems to have been doing so. Los Angeles, with the information and entertainment based economy there having really struggled to gain its footing over the last couple of years or so. Relatively slow economic growth there as well. Chicago, kind of a microcosm of the country in a sense, with slowing growth, slowing hiring, and in a market that's a really big and important market, but has in the past few years been a relatively slow growing one anyway. So I think you can explain a lot of that differentiation across markets in terms of office market performance by just what's going on in the macro economy. I will say that New York continues to be far and away the leader in at least the publicly available measures of return to office. So, higher transit ridership, higher foot traffic as measured by mobility data providers relative to not only its own past but also other major cities as well. So that's certainly a factor in that market's recovery.
Certainly. And what do you expect moving forward, Phil, as you look into your crystal ball for next year for performance?
Yeah, so we are in the process right now of updating our forecast. And I think one of the questions that we're going to have to think really hard about is, well, do we think this is an inflection point? Or are the headwinds of a slowing economy, slow hiring? Office using employment is actually still below where it was a couple years ago at this point. Hasn't really accelerated in the past couple of years. So, are those macroeconomic factors going to sort of overwhelm this budding recovery? So, we'll have to think long and hard about that. I will say that one of the strengths, well, I'll point to two of the strengths in driving demand in the office sector. One has been the financial services industries. So that's been another piece of New York's strong performance. It's also helped places like Dallas, which I mentioned, but places like Charlotte, North Carolina, Tampa, Florida as well, which have a base of financial services tenants. Another one is ambulatory healthcare services. So, in our large office category, we do include medical office. And so, growth in healthcare, physicians, administrative assistants, and all the support staff that serve patients in medical offices. That has been growing quite strongly, stronger than the rest of the economy. Hiring has been stronger in that particular industry than in the rest of the office using world. So that has benefited really everywhere, the segment of medical office buildings, but particularly if you think about places like, Arizona and Florida and Texas, where there's Chicago as well, where there's high growth in medical office and a big medical office sector.
Yeah, I mean, it makes sense. One, because it seems like we're all thinking about health more than maybe we have in the past, and being healthy and healthy foods. And then you have the baby boomers, right? Getting to where they're need. I'm one of them, I guess, but we need more health care. So that makes a lot of sense. Phil, when you look at um, projecting future performance in the office market. Obviously, we need jobs, and when you look at what's going on in the world economy, and especially with the Fed's interest rate plans. Do you look at what the Fed's interest rate might do, and does that help businesses expand more, or what do you think?
So one of the things that we think a lot about and is an input to our forecasting model is certainly interest rates, not so much the federal funds rate, but the 10-year treasury, which is a benchmark for a lot of commercial lending rates, as you know. The relationship between the Fed and its policy rate and the 10-year has been somewhat fraught in the past couple of years. They haven't necessarily behaved together as you might expect. The 10-year basically hasn't moved a whole lot in response to the last couple of downward movements in the federal funds rate. But certainly that is a factor in our outlook. Where does the 10-year go? Now, we have a third party economics provider, Oxford Economics, who provides a forecast of where the 10-year yield will go. And so that's an input into our forecast as well. I will say, in terms of office market performance, a couple of things that we think about, in addition to the traditional drivers of employment growth, economic growth, interest rates, we think about what's going on with sort of office utilization in office employment. So how much is the space actually getting used? And then how much space do occupiers need per person using that space? So both of those things, kind of the level of in-office utilization, and then the amount of square feet per worker, those things had a pretty clear and steady trend before the pandemic, right? We had less space per worker. That ratio was slowly decreasing as companies got more efficient with their space. And on the other hand, we had a downward trend in office utilization. We had more people already before the pandemic spending a little bit less time in the office. Now, that didn't always necessarily mean they didn't need a seat, um, but there was an identifiable trend in place. Now, both of those things kind of went haywire when the pandemic hit in 2020, and it's taken a while for them to sort of restabilize and establish new trends at different levels. But it does appear that both of those things are resuming their previous trends, or at least kind of reverting back toward their previous trends. And that's one of the things we think about as we consider our outlook.
Okay, well, there's two teases there from my audience, and now they're wondering, one, what is this 10-year forecast for the Treasury?
I'm going to just pull the honest answer out and say I don't know, because I haven't looked at it in the past couple of weeks. But the last numbers I remember looking at was there wasn't expected to be a lot of change. So somewhere plus or minus 4% in the next few years is I think what Oxford is projecting. But I don't know the precise answer to that. Sorry.
Okay. Or what about the other thing I think you just teased my audience with is square foot office user square footage per person. What are the trends you're seeing there?
Yeah, so we have an estimate of how much space is occupied per worker who's actually attending an office, and whether that attendance is once a week or 5 times a week or whatever. It's a worker who is actually using the office at any given time. And so, according to our estimate, in 2019, that had trended down to about 230 square feet or so. And this is not us going in with our CoStar cameras and measuring how many people are in the office and how big the office is. That's not what we're doing. This is just the mathematics of how many people do we estimate are actually using office space, and then how much do we at CoStar understand to be occupied by an entity. So when you just do that math, that ratio was around 230 square feet at the end of 2019. And then, like I said, it went haywire, right? It went up and down and all around over certainly the next 2 years. It started to stabilize at a much higher level a couple years ago. Think 250 square feet because you have fewer people coming into the space. And yes, occupancy had reduced as well, but not by as much as the amount of people using the space. Anyway, that has come down to around 240, and we expect it's going to, over the next, call it 5 years or so, settle back toward that 230-ish square feet per what I'll call attending worker.
Interesting. Yeah, I've toured two really large office buildings in the last week, and kind of visually saw the folks work. And we went in every suite on these buildings that we're selling, and it was interesting to see the activity and the amount of, and most of the companies, the businesses were very active, pretty crowded, I'd say, about employee per person. But then you did see these outliers that that looked like they had 1,000 square feet a person.
Yeah, well, absolutely, and that's like one of the things that is important to remember is exactly what you've just said, Michael, which is there is so much variability here, and this is not moving as one single monolith, right? If you go into the offices of a major bank in Manhattan, which I have done relatively recently. It's full. If you go into CoStar headquarters in Arlington, Virginia, which is a lovely building, beautiful building, you go into one of the floors there, and it's full of people sitting at their desk. And so um, you have that situation certainly, but then you also have situations where you go into an office and there are a couple of people on an entire floor, and that's still happening in some places. I would say one of the lessons of not just the post-pandemic era, but also of this period of really slow hiring that we've had for the past couple of years, is that occupiers at the margin may decide not to take on that extra floor of growth space, right? And so when they decide and when they look ahead and say, okay, I might hire a couple people in the next year or so, but I don't need to think about growing my headcount and therefore my office footprint by 10%. So I don't need that additional capacity. Um, and so when you forego that additional capacity, then that's one of the things that just contributes to that math, right, of occupancy per worker going down. And it doesn't necessarily mean the space is less dense in terms of where people are actually doing their work. It does mean that there is just less, there's more efficiency overall, right, with less space being paid for by occupiers per worker that is using that space.
Does AI gauge at all in your forecast for employment and office use moving forward?
Yeah, so this is another one where I have no qualms at all in saying I don't know, other than what the folks at Oxford talk to us about when we have this discussion. So, AI is in a sense baked into their employment forecasts. I will say, and they would, I'm sure, agree. Uh, there are error bars around that forecast, right? There's a lot of uncertainty in terms of what AI will do to traditional office using jobs. Um, I think there's a couple of different ways to look at it. One is you could interpret the slow hiring of the past couple of years, particularly in the tech sector, as perhaps an early impact of AI, right? It could be that they have slowed hiring in part because they are solving problems already with artificial intelligence that perhaps a couple or 3 years ago they might have spun up a new Scrum team. That's a possibility. On the other hand, um, it could be that AI means means that we're going to need more people in the future, right? To one, to do AI specific jobs, and then two, to sort of calibrate it into business use cases and move it beyond the realm of party tricks. And I don't mean to disparage it. I know it's much more capable than that already. Um, but I also know that there's been huge investment in artificial intelligence, and I'm not sure that the return on that investment as yet has been commensurate with that investment. So it could be that in either scenario, we're going to need more people to help figure out how to make this work.
Well, if we have a bunch of robots doing things, these robots might need space, right? I mean,
They might. Maybe they'll work in warehouses instead of office buildings. Well,
yeah. Well, it sounds like the future's getting closer to what we thought the future would be when we were kids, watching the Jetsons. We're going to have helicopters, electric helicopters, running us around the town. We have robots helping us in our homes. So it's interesting when we look at the office environment, how that's going to impact. And when you look at future performance, there's some consideration in AI. There's some consideration in interest rates, and how much of consideration there is in new supply, and the fact that you talked about A minus and B plus maybe starting to backfill a little bit. Obviously, new supply is going to be very expensive rent and very high in space typically, right? So and some buildings are getting torn down, right? You guys still seeing some buildings demolished. Does that potentially help this A minus B plus market moving forward?
yeah, so there's a lot that could be said about
Mhm.
the supply side. I think one of the key implications now, with essentially a generationally low amount of new supply set to come online in the coming years, is what is available and what is not available together changes the definition of what is desirable. And what I mean by that is, if you have a shiny, gleaming new trophy tower in the middle of the CBD, or in the middle of a market like West Midtown in Atlanta, or Fulton Market in Chicago, or Uptown Dallas, or a place like that, it's pretty easy to identify. Okay, that's desirable space, right? But what if you don't have a lot of those buildings, or any of those buildings? What then becomes good? In some cases, it will be about, okay, well, there's a new building that's a couple years old. It's maybe not in the perfect location, but gosh, it has really great fit and finish. It's still reasonably accessible, and it's got enough amenities. I think that's desirable space. On the other hand, it could be that that mid-block class B tower in Manhattan that's on 47th and 5th, um, that may start looking a little bit better than it did a couple years ago, in the absence of the availability of the new trophy product. So the definition of what is good and what is desirable, I think, could start to shift. One of the things that we noticed in Q3 in our early data is that B class space generally started to backfill for really the first time since the pandemic. It had really been struggling to even maintain occupancy, had been consistently losing occupancy until the third quarter, when it started to turn positive again. So I think that's an indication that tenants are changing their definition of what good is, and part of that is certainly a response to new supply.
Yeah, yeah, it makes sense. And it's interesting when you look at the new supply not competing with that older product. Looking for what's that happen? Does that force some of these folks down instead of saying, "Hey, that's really more affordable and it's okay." I just took out a lender-owned office building for sale, 95% occupied, 9 cap. It's got all the positive things on condition and lease terms. And when I took it out, I'm like, how's the investment market going to react to a 9% cap rate office building today? And I was actually curious because I've been selling a lot of distressed office buildings and then small user office buildings, and the market has responded very well. I think one of the things they're looking at was, well, I'm only at $100 a foot here. who's going to compete with me down the road when we look at replacement costs. And I mentioned that to tee you up for transaction volume. What have you seen as you look through the third quarter results so far on transaction volume?
Yeah, sure. Let me come to that in just a minute because you said something that reminded me of a point I wanted to make about supply. There is another side to this. I spoke to a major corporate occupier about a week ago, um, and I'm paraphrasing here, but essentially their point of view was, look, if we can't have space that fits our standard, then we're just going to forego the space and we'll make do with what we have. So there are both things going on, right? There's this dynamic of some occupiers are like, no, we'll just stay where we are in the absence of the new trophy space that meets our spec. And there are other occupiers that are like, okay, we're going to be more flexible on either building quality or location. And so I think for the buyers coming in at that, $100 a foot price point, they have an interesting decision to make. Do I ride the low basis, avoid investing too heavily in capital improvements, drop my rents to meet the market for those more price conscious tenants, and then try to get a return that way? Or do I buy at a low basis, then have the capital left over to invest to try to be, if not trophy level, then at least reasonably competitive and attract some of those tenants that have a firmer requirements for their spec? So that is an interesting, I'll say, decision to make for those who are buying in the market. Now, as to those buying in the market, we have seen a lot more of that. So to your question, in Q3, we saw transaction volume um, essentially at a level that mirrored pre-pandemic activity. So
Hmm.
it looks like year over year. So if you go back to the first quarter of this year and the second quarter of this year, both of those were up probably 65 to 70% year over year.
Wow.
And then Q3 of this year looks like it was more like 100% year over year. Now we'll see what the final numbers say. It might not be quite that, but if that's anywhere close to true, then that would be essentially the level of activity that we were used to seeing on a quarterly basis before the pandemic. So I think buyers have. And sellers, but they've gotten used to the idea of, yes, rates are higher for longer, costs of capital are going to be higher, and we're just going to have to deal with that. So I've heard from some buyers that financing is available but expensive, and that's kind of the reality that they live in. Debt funds are a small piece of that.
Yeah.
So
Mhm.
yeah, so we've got this situation of the market coming together, the bid ask spread narrowing. The other thing that we've seen is really the return of institutional buyers. So their share of activity had really cratered until maybe 12 months ago. It started picking back up again. Now they're not quite back to their traditional share in terms of how active they are on the buy side in the capital markets, but they are returning. And as a consequence, the share of buildings being bought by occupiers is actually kind of reverting to its historical norm after being elevated for a while.
Yeah, that's interesting because we've certainly seen a lot of that with users deciding to go ahead and buy while these bases are so low. So that's happening a little bit less, and more of the investors are winning these battles.
Yeah, and it may not actually be that the occupiers are buying less. It's hard for us to tell with as given how early the data is. It could just be that the institutions are coming back in on the types of deals that just weren't getting done a year or two ago.
Yeah, good point. So, what do you expect for transaction volume moving forward?
Well, it's hard to have that crystal ball, but I think the indications are that there is less of a bid ask spread for the sort of questionable or assets with questions about it, right? Like everybody knew what a fully stabilized, fully leased, long term wall, maybe single tenant building was worth. More recently, everyone started to know what an essentially completely vacant building was worth. And it was that What about if I'm 80% occupied, have a little bit of rollover exposure in the next couple of years? What's that building worth? So I think we're starting to come to an agreement there, and hence we've seen this uptick in transaction volume. Um, the other thing to say is that while that's an encouraging sign for many building owners and certainly those looking to invest, there are still some choppy waters out there, right? So we've got CMBS delinquency rate on office CMBS loans that's 11-ish% now, which is as high as it's really ever been. Um, so that's an indication that, yeah, there probably will be more, there definitely will be more distress out there. I don't think, as we've discussed before, Michael, I don't think that's all going to hit at once. That's going to have a kind of a long period of playing out. So, there are some headwinds ahead. We could actually still see average pricing fall a little because of that. On the other hand, we may be at the trough. And I think, regardless, whether there's a distress sale wave that sort of brings overall values down or not, the key is that investors are starting to come to terms with, A, what the cost of capital is, and B, what these properties are truly worth.
Yeah, it's a good point. And your earlier point that the 10-year projection is really pretty stable, right? And that so a lot of participants figuring, we're probably in the normal historic interest rate range, and we're not going to have a significant reduction there. So I guess it's okay to get in the water, right?
Right. Yeah. And, it's the stability in interest rates recently that I think has really triggered, as much as anything, this kind of resurgence in volume.
Yeah, on the pricing discovery, I focus on selling office buildings and helping lenders with REO, and we just took out an office building at a 9 cap, and I was curious myself because I've sold a lot of distress what the market would say, and I think the market is figuring out, what if it's okay, and lenders are looking at. We've got lenders approving the loans. Still, some lenders say no office, Michael, no, sell these notes for us. But some lenders are like, okay, we get it. That's a good market. It's a low basis, and so we are seeing some pricing discovery that people are kind of feeling comfortable. Because at the same time, I've got other clients asking me, Michael, if you took out my stable A-, B+, what would it bring? And to your point, maybe in the last couple of years, I'm like, yeah, I'm not really sure.
That's right.
Yeah,
Yeah.
but we're
And I think,
starting to feel it, right?
and I think, in fairness to some of those lenders who, let's be honest, have still essentially redlined the sector, it's not that many of them don't necessarily appreciate that there are good deals to be done out there. It's that they have a book of existing loans that they're still busy working out. So, I think part of that is as much a capacity issue on their part. And it takes a lot of headspace to work out these loans in creative ways sometimes. And not just because, they don't recognize that there could be some opportunities out there.
Yeah. Well, you certainly don't want your workout guys getting back into production. They're going to be not going to be good at production after being on the workout side. We've certainly seen that. Bill, what would you leave our audience with to think about for the office sector?
Well, I'll leave you with two things. So, through the magic of the internet, I have just confirmed that the long term forecast for the 10-year Treasury yield that we will be using is just over 4%. It's about 4.2. So I wasn't entirely wrong when I gave you a guess on that earlier. I would say that, as we look at the next few quarters in the office market, look for signs that that inflection point really is happening. So, is space that was vacated in the last 5 years getting backfilled? If so, that could be a sign that we're at an inflection point. Are the terms of lease deals really changing? So, we had a big run up in lease concessions, free rent, and TIs, for example. Um, and those started to come down for trophy properties as the supply of that stuff started dwindling. But are those concessions starting to come down for other properties? If so, maybe that's a sign that there is a true inflection point. And another thing to keep in mind is that while we have these macro forces, we also still have the sorting of tenants into what they define as the best buildings, right? So whether that's the quality of fit and finish, the amenities, the location, all whatever the sliding scale is that's a part of the package of that building. What we've seen is that vacancy has been concentrating in the same high vacancy buildings, right? So there are actually more of those high vacancy buildings. So if you go back 10 years, you had maybe 1 out of 6 buildings was a high vacancy building. And now it's more like 1 out of 5. And 10 years ago, that 1 out of 6 buildings had maybe 2/3 of all vacant space was in those buildings. And now in the high vacancy buildings, it's more like 80% of vacant space. So tenants are really sorting out of and into buildings that make sense for them. And so that's a dynamic that we expect to continue, even if the overall market does hit that inflection point and start to turn around.
Yeah, that's a good point. And some of those vacant buildings aren't really on the market. We just sold a 185,000 square foot building, and it hasn't been on the lease market really. It shows as vacant. It's adding to the vacancy, but there was no TI or LC. It wasn't. The tenant reps were no, 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 and even the ownership group and the lender like, now we're not doing the loan. So, in some cases, the vacancy might look worse than it really is on the buildings that are really running properly, right?
Yeah, it's a great point because there's always been a little bit of a gap between what's vacant and what's competitive, and that gap today is wider than it was 6 years ago. So certainly, you can look at the headline vacancy rates. I'm not suggesting those don't matter, but in terms of what's truly relevant and competitive, it's a different set of space when you're trying to get a deal done for sure.
Yeah, a good point. A lot of good points and great information as usual, Phil. Thanks for joining us.
Yeah, anytime, Michael.
All right, and thank you for joining us around the country. And I'll leave you some thoughts. If you like the office market, if you want to sell a note, you're a lender, you want to sell a building as a seller, distressed seller, or a stable building. We're getting good prices now for stable buildings. If you're an investor, if you're a user, you might want to consider buying office. So if you want to do any of those things, reach out to you. If we're not the right match to help you, we're in the Southeast U.S. We'll get you with the right folks. Or if you have any questions on any commercial real estate, please send it to me. I'll be glad to point you in the right direction. My email is an easy one. It's michael@bullrealty.com. Well, thank you for watching the show. Thanks for sharing it. Please connect with us. And until next week, be sure that you always lead, learn, and laugh. And join us for America's Commercial Real Estate Show. America's Commercial Real Estate Show is brought to you by Bull Realty. For commercial brokerage sales and leasing in the Southeast U.S., contact our show host by email at michael@bullrealty.com. By Commercial Agent Success Strategies, 21 incredible one-hour agent training videos. Learn more at commercialagentsuccess.com. For more podcasts and videos, subscribe and visit creshow.com.